Hi guys, welcome back to another video. My name is Josh, and in this video I'll be talking about how we can find 10 bagger stocks. So a 10 bagger is basically a stock that has 10 times its value. So when you put in $1 today, it's worth $10. So you 10x to your money, a 10 bagger stock. And this term is famously coined by Peter Lynch. He's a very successful fund manager who wrote the book One Up on Wall Street. And in his book, he talks about how we can find 10 bagger stocks. So today I'll be taking a look at some of the examples that we can take out from the New Zealand market. I'll be comparing two different types of 10 bagger stocks. And from this, we can draw sort of some of the lessons, what we can take out from these stocks, what was the factors that caused these stocks to be 10 baggers. Okay, so if you enjoy content like this, be sure to like and subscribe. I post a lot on Instagram as well, so be sure to follow me on Instagram. I'm not recommending stocks that I talk about in this video. I'm just using them as an example of how we can find 10 bagger stocks. This video is purely for entertainment and educational purposes only. Cool, let's get started. So first example we have is A2 Milk. So this stock is a very famous New Zealand milk company. They make A2 Milk, and if you bought this stock in 2015 and you held it on to today, you'll be up about 2,700% or 27x your money, 27 times your money. So you would have done really well in the past 5 years. You would have beaten the index, no doubt. Okay. Next up, we have Mainfreight. So if you bought this stock at the GFC at the lowest point in 2009, fast forward till today, 11 years later, you would have made a 1,000% return on your money, or a 10x, 10 times your money. So this is a 10 bagger stock. A2 Milk in 2015 was a very high growth, unprofitable speculative investment. Okay, A2 Milk was not making money, but their revenue growth was about 40% year on year. And in 5 years, you would have made 27 times your initial investment. In 2009, Mainfreight was a well-established company turning a profit, and they were also paying a dividend. And in 11 years, you would have 10x your initial investment. In hindsight, if we look back, A2 Milk was the better investment, but Mainfreight was the easier investment. Okay, so what do I mean by easier investment? Mainfreight is definitely an easier 10 bagger. So let's take a look at the metrics at the time. At the time, A2 Milk was earning negative 33 cents per share. They had a share price of 72 cents. Mainfreight was trading at a price to earnings ratio of less than 10, EPS of 41 cents at a share price of $4.07. So if we compare the two stocks before they had a massive run up, I would say that Mainfreight is a less speculative stock. It would have been easier for me to put money into Mainfreight because they're already cash generative, they're paying a dividend. Whereas A2 Milk, you never know what's around the corner. They've lost 33 cents per share. And if you think about it, 2 years of losses continued at this rate effectively is the entire share price. Okay, so if you're looking at A2 Milk's perspective, they might need to come back for a capital raise. And if I had to put money in one of these stocks at this point in time, at that specific point in time, so FY15 for A2 Milk and FY9 for Mainfreight, I would have put it into Mainfreight because the fundamentals make more sense to me. Say, for example, if you were a genius and you saw A2 Milk's growth potential, then say you did buy into A2 Milk. In the next year, from 2015, it increased in share price from 72 cents to $1.88. This represents a return of about 150%. Would you be tempted to sell at this point? It's very difficult for holders to hold their stock when their shares go down. They would be tempted to sell. Likewise, it's very tempting for shareholders to sell their stock when the share price has returned 150% in the past year as well. Most people would take their money and run. If you sold out A2 Milk at $1.88, you would have missed out all the gain up to $16. So when you're faced with such tremendous gains in such a short period of time, you'd be very tempted to sell. Whereas Mainfreight, in the next year, they returned about 50%. So that would mean if their P ratio was about 10 times, it would now be about 15 times. Would you be tempted to sell? You would be, but not probably as much as A2 Milk was. You know, a PE of 15 times could still be justified at these levels. They were still paying a dividend. So at the time, you could probably make a case to hold Mainfreight, and the numbers were there to back it up. I would be more comfortable sleeping at night holding a larger allocation of Mainfreight than A2 Milk. So to me, A2 Milk was the better investment, but Mainfreight is the easier 10 bagger. It's easier for people to hold a stock like Mainfreight rather than a stock like A2 Milk. So in this video, let's take a look at what were the factors that caused Mainfreight to perform so well and make it a 10 bagger stock. So there's two determinants of share price. Share price is calculated by taking the PE ratio multiplied by earnings per share. And these two factors are basically what drives share prices. If you want to find a 10 bagger stock, then you'd have to increase both of these factors. You have to increase the PE ratio and you have to increase the earnings per share. So let's take a look at these two factors here. So the first one is the price to earnings ratio, and that's calculated by taking the share price divided by earnings per share. And the price to earnings ratio is a measure of valuation. The higher the PE multiple, the more investors are willing to pay for a stock. Companies that usually have a higher earnings multiple or price to earnings ratio have a higher consistency in generating free cash flow. That's why we have cyclical stocks like airlines, for example, trading at very low multiples. It's because their cash flow is not consistent. You know, some years where tourism is on the rise, they'll increase in cash flow, but then once a downturn comes and no one goes traveling, or you know, a coronavirus hits, then the cash flows take a hit as well. So there's very little consistency in that, and that's why they have a lower multiple. So we want to find a company that will increase in consistency in generating free cash flow. We also want the earnings growth rate to be high. Growth companies tend to trade at higher earnings multiples than a no growth company. And you also have other external factors that play an effect on your price to earnings ratio, and this is the interest rates. So the lower the interest rates, the higher the earnings multiples. I've made a video on this, interest rates and stock markets. Be sure to check that out. And market sentiment as well. If the market is bullish, if the market thinks that good things are going to come in the future, that this year is going to be a very rosy year, then the multiples will go up because people are willing to pay more for assets, for equities. Okay, so market sentiment. And lastly, it also depends on index inclusion. So once these companies reach a certain point where they're large enough and index funds are required to include it in the index, then that would cause the price to earnings multiple to go up. So these are the factors that would cause your price to earnings ratio to increase. And in 2009, these are your largest stocks, largest 10 stocks in 2009 on the NZX. And you can see Mainfreight wasn't there. Mainfreight at the time was about $300 million, okay? So they would be quite far away from the top 10 companies. And today they are in the top 10. And from not being in the top 10 to being in the top 10 would mean that the index would have to buy their stock, and that would cause the PE multiple to expand. Next factor is the earnings per share factor. So this is calculated by taking the net profit divided by shares outstanding, and this is a measure of the company's ability to earn on a per share basis. So if you buy one share, how much earnings does a company generate you for that one share? And this depends on multiple factors, some of them including a company's moat, whether they have a competitive advantage, industry tailwinds. So are there any factors within the industry that would cause a company to benefit from that? So for example, in Somerset's case, they're in the retirement village industry. New Zealand has an aging population, so more people will get older and they would need more retirement village services, and so this would be a industry tailwind for Somerset. Next up, we have management team. So whether the management team is good, able to drive earnings per share growth over time. And we also have share buybacks. So when a company buybacks its shares, they would reduce the shares outstanding here, and what that would cause is basically your calculation to go up, because the lower the denominator, the higher the output. So that's why companies and shareholders love buying shares back. And Warren Buffett does this as well. Sometimes the best investment a company can make is to buy back their own shares if they think the shares are undervalued. Yeah, Warren Buffett doesn't pay out dividends, but he does buy back shares to increase, shareholder value over time. So next up, we have the multiplier effect. The multiplier effect is basically what happens when you have an increase in PE ratio and an increase in earnings per share at the same time. Okay, so I have a calculation here to basically illustrate the multiplier effect. Say we have bought a stock at a 10 times PE ratio for $1, and they have 0% earnings growth. So if they trade at a PE multiple of 10 times, that stock will be worth $1. But say we increase the earnings per share by 10%, assuming that they trade at a P ratio of 10 times, they would trade now at $1.10. And this goes all the way. If we have an earnings per share growth of 200%, that stock will now be worth $3 per share. Okay, so a good return. Next, let's take a look at the PE expansion. So if they have a 0% EPS growth rate, but the PE expands to 11 times from 10 times, now that stock will be worth $1.10. And all the way down, if we go up to 30 times PE from 10 times, that share would grow to $3, okay? Now, if the PE ratio goes from 10 to 30 times and the earnings per share goes from 0% growth to 200% growth, so you've tripled your earnings per share, that doesn't mean that you have a sum of $6 per share now. It actually means that your share price is now worth $9. Okay, so you take 3 multiplied by 3 to get $9 per share instead of going from 3 plus 3, $6. No, that's not how the multiplier effect works. It's a multiplier effect because it multiplies 3 by 3 to get $9, okay? So when you have EPS growth and you have price to earnings multiple expansion, you get a significant increase in share price. Okay, so that is the multiplier effect. To wrap this video up, let's take a look at Mainfreight today. Mainfreight has a share price of $41.73. Its earnings per share has grown from 41 cents to $1.40. And its P ratio has expanded as well from just under 10 to 30.3 times. And that means that its share price has 10 times. It has grown from $4.07 in July 2009 to about $41.73 in February today. Okay, so it has done really well because it had PE expansion and EPS growth, which means big gains. Okay, so the main takeaways from this video is that we need to find stocks that have room for PE expansion, room to increase their price to earnings ratio, as well as room for EPS growth. Okay, so with 2 of these factors increasing, that would mean that your stock prices go up, and that's how you find these 10 bagger stocks. Okay, and that's really it for this video. If you found value in this video, be sure to like, subscribe, as well as follow me on Instagram. I post regularly on Instagram. So I hope you enjoyed this video. Until next time, take care.